All right. Hello, everyone. Welcome to Mortgages, Trust Deeds, Notes, and Private Lending with Marshall Reddick Real Estate. So excited to be here with you today, and there's tons of value in this presentation. So excited that we get to share a little bit more about our private lending program in general and the mortgage marketplace specifically. Now, when I talk about the mortgage marketplace, I want to give you a brief glance before diving in, so you can have an idea of what I am talking about. You can find our marketplace by navigating here. On your screen, you should see our Marshall Reddick homepage. And if you would come up to the Invest tab and hover over Mortgages, you then, after selecting that, will load the following page. This is a live look at our marketplace today, and I'll circle back to show you how to conduct your own exploration of this site momentarily. So I see a lot of familiar names on the call, so thank you guys all for being here. It's great to see you. But I also noticed that there's a good number of new folks tuning in as well, which is fantastic. To give a little bit of a roadmap as to what you can expect from this presentation, this webinar is geared towards helping both our existing and prospective mortgage, trust deed, and note investors better understand the mechanics of our programs and to demonstrate how best to take advantage of the resources we offer on our mortgage marketplace. Whether you have been lending with us for a decade or this is your first time seeking us out, this webinar is jammed packed with loads of great content for all experience levels. Before diving into the main presentation, I'd like to give a minute to introduce myself, as well as to give a brief background on the private lending program as a whole. Also, throughout this presentation, feel free to leave your comments in the chat for us to potentially answer in our Q&A section at the end of the presentation. So first off, my name is Byrne. I'm one of the investment analysts here at Marshall Reddick Real Estate. My job is to analyze risk by looking into all the nitty-gritty details of the subject property, such as the square footage, the beds and baths, zoning class, establish a value for that property, and ensure that the corresponding loan structure and documentation is in order to best protect the lender on every transaction. I was born and raised in Orange County, California, and graduated top of my class at Vanguard University with my BA in business. I began my journey here with Marshall Reddick in 2019, and I'm super passionate about pursuing financial independence through real estate. Honored to be sharing this time with you and appreciate your patience as we go through the material. So, switching gears to the lending program, Marshall Reddick as a company has been around since 1979. We have a rich legacy, and it's thanks to this amazing team of professionals here and wonderful clients like yourself who have helped us stay going strong for over 40 years. Regarding the private lending side of the business, we have been in the private lending space for more than a decade. It started out with us lending to our longtime referral agents who were buying properties on the courthouse steps. But we eventually opened up these lending opportunities to our longtime Marshall Reddick investor clients, and it's only gotten bigger and better from there. Today, we primarily work with two types of investors. First, we work with borrowers who are searching for financing solutions for their real estate investing, whether they're aiming to complete a fix and flip, follow the BRRR method or BRRR method as it's affectionately called, or buy and hold their property as a rental. The borrowers seek out Marshall Reddick to help them accomplish their goals in real estate. On the other hand, we also work with folks who are interested in the passive income offered by secured debt notes. After taking the loan application from our borrowers and evaluating the deal to determine if it fits within our proprietary guidelines, we then offer those approved loans as investment opportunities to our direct lenders, like yourselves, or to our mortgage fund, which I will touch a little bit more in the presentation, but be advised, specifically, we're going to be gearing more towards the direct lending side in this webinar. So as current or potential note investors, I think it is important to note that we actually publish our loan programs publicly on the website for our borrowers to review. This also adds value for our note investors. If you are curious about note investing and want to get an idea of what types of opportunities we will have available to invest in, you can view our suite of loan programs by visiting our website. I'm going to direct my attention back on our home screen here. And if you go up to the Borrow tab directly next to Invest and select Loan Programs, I'm going to open this page in a new tab. You will find the full suite of our loan programs here. I'm not going to spend any time going over these today, but I wanted to point it out for your further exploration after the webinar. So in our lending program, we have two options for our investors. There is the direct lending or pooled investing with the Marshall Reddick Mortgage Fund. As with anything, there are pros and cons to either option, but our number one focus is that we service the needs of all of our clients, and each of these routes offer different value to a variety of investors. For example, some of our clients prefer to be more hands-on in selecting and funding their secured debt notes, while others are searching for a more passive approach where we do the choosing and investing for them. For the sake of this presentation, I'm going to focus specifically on the direct lending option, as I mentioned before. But nevertheless, regardless of which option you choose, the underlying investment is the same. It is low risk, solid LTV or loan to value for those who are not familiar with the acronym, first lien secured debt, fully underwritten by a Marshall Reddick investment analyst like myself. So circling back now to the marketplace, to try and give a brief description of what that mortgage marketplace is, picture it as a sort of MLS or multiple listing service for those who are unaware of the term. The MLS in real estate is where all the homes listed for sale are publicized for realtors to find properties for their clients. Our marketplace acts in the same way, but for mortgages, trust deeds, and notes. Through this platform, lenders can access their loan portfolio, check for updates on their current investments, shop new opportunities in real time, and conduct research about our past history, our default rate, as well as reviewing the markets in which we lend. I will touch more on how you can view that historical data later on in the presentation, but a key takeaway for right now is that the platform that we've created offers a tremendous upside for our investors by providing valuable resources to help you make educated investment decisions. So like I mentioned before, we started getting more demand for our lending products, and it prompted us to launch the mortgage marketplace back in 2016. I'm going to go ahead and navigate back to the marketplace here quickly so you can see that for yourself. We have an in-house software development team who helped us design a proprietary, fully customized platform and system specifically tailored to our operations. When working with us, we are providing top-of-the-line software that has been designed with you in mind, not like some other lending companies who use a third-party system and modify it to suit their needs. So get the word out. Since 2016, the mortgage marketplace has had thousands of loans originated and sold across the platform. Not only that, but every loan that has come through our marketplace is left available for the general public to review, meaning you can always see our current and historical pipeline in real time. I also think that it's important to note that due to our growing loan volume and the rise of the fund, the marketplace is also developing into a hub for secondary market transactions where people can buy and sell first lien debt. We are always seeking to grow and evolve the software or lending opportunities, so your feedback as the client is greatly appreciated as we continue to modify our platform to best serve our investors. So now that you know a little bit more about the marketplace, let's talk a few private lending basics that I think are important to know for any mortgage, trust deed, or note investor. First, when you choose to originate a note or to buy a loan on our marketplace, you effectively become the bank. Same as a conventional lender like Bank of America or Wells Fargo, you lend your dollars out to a borrower in order to earn interest payments in monthly installments. Whether these payments are fully or partially amortized, and sometimes maybe even interest only, these monthly installments serve as your return on investment. As long as your dollars are out, you are earning interest. A side note is in many ways, you can look at note investing as superior to owning a rental property as it is a more passive option. If that's important to you as an investor, I recommend getting involved in the debt lending space, as you do not need to worry about things like property maintenance, vacancy, or other headaches that come with being a rental property owner. While there are pros and cons to either option, and both offer tremendous value for specific types of investors, for our note investors, the only worry that they have is collecting their check in the mailbox each month, which is an incredibly passive income opportunity, in my opinion. A second important function that I would like to mention is that, like the bank, you, as the lender, own 100% of the note. So again, touching back, this presentation is geared toward the individual investor, or our direct lending model. In this model, we operate on a 1-to-1 ratio, meaning that only one lender will fund one loan. I want to highlight that in our direct lending model, which I'm covering today, there is no crowdfunding. To help illustrate this point, I'm going to go ahead and navigate back to the marketplace for a moment. As you can see, all these listings have a certain investment capital associated with them. You can see those numbers here. If an opportunity on our marketplace shows the needed investment capital as, say, for example, $100,000, the individual investor must personally supply the entire investment amount. We avoid fractionalizing between multiple lenders in our direct model, meaning that the investment is owned by you, and you collect 100% of the interest, and you bear 100% of the responsibility for the note up through completion, whatever that may be. Now, don't let that last part scare you, as we are here to help and provide resources to help you make an educated decision on every loan you fund. However, just like with every investment, there is an element of risk that is vital you understand when entering the private lending space. So finally, Marshall Reddick steps into the picture by brokering these lending opportunities for our clients. We work with hundreds of reoccurring borrowers in markets across the country who are investing in real estate and bring their deals to us for the funding. Now, please note that just because a borrower comes to us with a lending opportunity does not mean that their deal ends up on the marketplace. Before getting to that point in the process, Marshall Reddick vets each deal and asks questions such as, what is the borrower's experience level? Where's the location of the subject property? What's the borrower's exit strategy? Details about the subject property, and so on. All this is done by an investment analyst, such as myself, before making the note available on the mortgage marketplace. And I firmly believe that our attention to detail and commitment to being conservative is what has kept our historical default rate impressively low, and we intend to keep it that way. Now, some of you on the call might be asking yourselves, since we broker the opportunities and put in so much effort, how does Marshall Reddick get paid on every transaction? That's a fair question, and I get asked that all the time. So I want to circle back to cover that question in greater detail during the frequently asked questions section at the end of this presentation. So now that we've sort of covered a little bit about the marketplace, what it is, how it's an MLS, but for mortgages, trust deeds, and notes, and a little bit of the private lending basics and how we as Marshall Reddick fit in, I want to now take a time to now jump to the marketplace and show you how to utilize some of the tools that we make available to you as the investor. So again, I'm going to come back to the marketplace, and from the home screen, to get there, all you need to do is hover over Invest and click Mortgages. I'm going to go ahead and switch over to my new tab. And as you can see, this page right here is where our direct lenders go when they are looking to shop for new investment opportunities, or where a prospective investor can go to conduct further due diligence before getting involved. Right now, we are in List View. As you can see, there are a list of opportunities on the screen. And it shows all the loans that have made it in front of our investors that are either funded, completed, or in the process of being funded. If you look to the top right of my screen right here, you can see that right now, without any filters, over 2,000 results are showing. Likely, all of these will not be relevant to you or for what you are looking for. So I'd like to take some time to demonstrate how you can further refine the listings that appear on the website to best suit your needs. You can begin navigating the marketplace by first clicking the clear button up here in this top right corner. I always do this first, as it ensures you receive an accurate search result by removing any prior filters that may have been in place. Once that is complete, then you can move to the More Filter section. And in this section, you can see the various options available for you as the investor to further refine your search. We have a tremendous wealth of search criteria to help you find basically any report that you'd be curious to run. As it would likely take much longer than we have scheduled for today to show you everything, I'll focus on highlighting 3 filters that I use daily as an analyst and believe will be most helpful to you as an investor. So first, I want to draw your attention to the loan status filter. This filter is excellent for quickly searching through loans by their status in the funding process. You can find this filter in the center of the More Filters dropdown. My cursor is hovering over it right here. In this loan status filter, you can see that there are 5 buckets, if you will, and it helps you navigate. The first is the needs funding bucket. Any available loan statuses below here are those that need funding. Then there's the pending bucket. The corresponding loan statuses are currently pending, about to be funded. Then we have those that are active. Those are the ones that are currently in play today. Then the final 2 are those loans that are completed, either paid in full or completed in some form of default. Further, these loan statuses will help you understand where each listing is in the funding process. Underneath each of these 5 buckets, you will see the various loan statuses. And under needs funding, you see that there's available, funding in process, and so on. For more information about these loan statuses, you can click the loan status definition link that's right here. I'm going to go ahead and jump to this in the new tab so we can all see it. This right here is an article that goes into further detail about the various loan statuses and what they mean. So for example, I'm going to go ahead and read the available status, which comes up in the top of the list. Available is those Marshall Reddick underwriting is complete, the loan is approved, and now it is available for investment on our mortgage marketplace. If you are curious about the other loan statuses, you can peruse this article at your convenience after this presentation. Now that we know what the available status means, to sort through our listings and pull out only those that are available, you would simply need to clear, as I always start my searches by clearing, then come over to the loan status filter and click deselect all. After doing so, now no loans under loan status, available, funding in process, or any of these other statuses are selected. This allows me to only select those loans that are currently available for funding. And now you can see to the right that there are 6 loans in this status, and on the top left, 6 mortgages were found from my search, so it matches. By clicking done, I now have a list view of all the loan listings that we have available for funding in real time. So switching gears from the loan status filter, I now want to demonstrate the ability to choose between transaction type. This is also in the More Filters section. So to get there, I'm going to go ahead and open the More Filters. And it is found directly below the loan status filter under transaction type. As you can see, there are 2 types available on the website. Originated loan transactions, which we have historically done the most, represents a live deal for one of our borrowers. That deal could be a purchase money loan, a refinance loan, or some other kind of lending program. And your investment is funding a brand new origination. Opposite to that is the buy a loan transaction type, which a new loan is not being originated, but rather you are buying an originally or previously originated note from another lender. Now, there are pros and cons to both options, but using the buy a loan transaction type as an example, a potential benefit to the investor is getting to see the borrower's payment history before funding the note. In some cases, these loans have been originated for many months, meaning that an incoming lender can review the timelines of the borrower's payment before purchasing the note, which can add value to that investor. And as the marketplace evolves, you will start to see more and more of this type of transaction on the marketplace. Now, I want to take a quick break from the various filters that we've been showing you, the loan status and also the transaction type, to instead cover the two types of views that you will see on the website. The two types are list view and the full details view. I'm going to go ahead and navigate to the list view by clicking done. And as you can see, my original search, where I searched for those loans that are currently in the loan status of available, are still on screen. This is the list view. And as you can see, it allows you to peruse multiple opportunities in a snapshot without getting into too much detail. But once you find a loan that looks attractive, you can click on the full details view to continue your due diligence. By doing so, all you have to do is hover over the listing that is available. This one right here is on 52nd Avenue in Glendale, Arizona. And if I wanted to see more, all I would have to do is open this full details view in a new tab. Once I do that, it will take me to the following screen. This is the default view. For the full details view, we have two sections. As you can see, there is a loan information field, and there's also a property information field. We feel that we provide all the pertinent information for your review in order to make an educated decision. And all that information is contained, the work done by the underwriter, in these two fields. So, for example, let's go ahead and look at the loan details section under the loan information field. As you can see, it shows a variety of details about the loan. This loan right here is a purchase. The borrower was acquiring a new property. The exit strategy for this borrower is to sell, which means likely this borrower is trying to complete a fix and flip on this deal. There are some further loan categories down here, like going into the loan terms, where you get to see the loan amount at origination, the payment type, and so on. Switching gears, I now want to use one of the filters in the property information field. I'm going to go ahead and go down to the property type, and in this field, it will show you all the different details about that particular subject property. In this case, it is a single family residence built in 1979, roughly a 10,000 square foot lot that is a 4-bed, 2-bath home. After going through these various filters and these various fields and finding a loan that you think is the best option for you, you can commit to funding that deal by clicking the green button, which can be found here on the website. Now, I am currently logged out, but in the event that you would like to commit to funding this deal and your first time, it's very simple to do by clicking create an account. As you can see, the information we're asking for is not invasive. Our goal is just to collect the relevant and pertinent information necessary for you to successfully fund the deal. So I will go ahead and log in briefly, just to sort of show you what that next page would look like. So once you log in or create an account if you're new, this next page is where you then begin putting in more of the specific details geared towards how you would like to invest. You can choose whether you invest personally under your own name, or if you have an entity of some kind, like a self-directed IRA or perhaps an LLC. And this would be the opportunity for you to hammer home how you would like your investing entity to appear on the mortgage. Now, on the other hand, if you have questions about the listing and you're not quite sure how to answer them using the information already provided on the full details view, you can click the blue request information button. Once you do so, again, non-invasive information, but just enough contact details for us to be able to get back to you and offer our assistance in answering those questions for you so that you can get the most pertinent information for that traditional listing. I'm going to go ahead and log back out. So up till now, the tools that I have demonstrated how to use have been centered around investing. Changing from what a direct lenders use when selecting an investment, I would now like to show a few examples of how you as a prospective lender can conduct your due diligence on the marketplace. I will do this by demonstrating how to review both our current and historical pipeline, as well as review our mortgage fund's activity and calculate our default rate in real time. To start, I will take you through how you can see the loans that are currently active in our pipeline right now. Again, I always start by clearing my filter to make sure I wipe out any other search fields that might have been in there. And then I'm going to go ahead and go into my More Filter section, back to my loan status filter. As I promised, this is a field that is very useful to me and I use all the time. And scrolling down, I'm going to go ahead to deselect all and instead only select those loan statuses that are in this active button. As you can see, this search results in over 500 mortgages on our website. These are the loans that currently have our dollars out with the borrowers, earning interest for our lenders. Currently, we have a pipeline of over $50 million in the market across the country, which is a truly humbling number and one that I am grateful towards our clients for their continued trust as we continue to grow and build. Now, we are very hands-on. So although there are hundreds of loans out, we are consistently managing and checking the pipeline. We are watching which loans are coming due. We are checking to make sure that property taxes and insurance are paid and current. We are making sure that we're checking on those progress properties that have renovation draws out. We want to make sure that in every situation, we are on a regular basis tracking our pipeline to mitigate the risk for our lenders. Now, on the flip side, I want to show you how you can look at our historical pipeline. To do so, I'm going to come back up to my clear button, always clear after a filter. I'm going to go back to my loan status filter and click deselect all. And then I'm going to scroll down and select those that are in the completed buckets, whether paid in full or completed with some form of default. We are incredibly transparent, and we feel that more lenders should be. So we have no qualms about having our data available for our lenders to view. This is an incredible resource as it allows investors to see what markets we lend in, what our default rate is. And you can actually review details about the loans that did not go expected. So you as the investor can make an educated decision about which loans worked and which loans didn't. Now, I promise I'm going to look at the default rate. So I will circle back momentarily to show you how you can do that. Now, as discussed earlier, this presentation is specifically geared towards our direct investors. However, I did mention that there are two investing options. There is the direct lending option, and then there is the pooled investment or mortgage fund. The mortgage marketplace has the ability to sort between these two options, so you can differentiate between which investments are held by lenders like yourself and which are assets held by the fund. To find that number, I'm going to go ahead and clear my filters once again. And then I'm going to scroll down much farther than before. And on this left-hand side, you'll see the filter titled Mortgage Owner. This is a benefit for fund investors to review the fund's holdings in real time. If I deselect the individual investor, I now will only see those loans that the fund is holding. Almost 200 mortgages appear. On the flip side, if I'm curious as an individual investor how many other loans are held by mortgage, trustee, or note lenders like myself, I can simply deselect the mortgage fund and reselect the individual investor filter. And as you can see, we have done over almost 2,000 loans with our direct investors. However, it's important to note that as the mortgage fund continues to grow, you will see more and more notes being held by that entity. I'm going to go ahead and clear my filters once again. And as promised, for our last navigational feature I will go over today, I'm now going to circle back to show how you can calculate our default rate using the website in real time. So first, I'm going to go ahead and come back to clear once again. I always clear before starting a new filter just in case. And I'm now going to look at what our active loans are and what our completed loans are. which you can find right here. Now, to calculate our default rate, I'm going to specifically focus on those loans that are completed or completed in default. So I'm going to go up here to my loan status and deselect all. For my denominator, I need to know how many loans have been completed in the entire history of the mortgage marketplace. I can find that number by selecting all the loan statuses that are either completed or completed in default. After doing so, you will see up here in the top left that 1583 is the number that arrives. This is going to be my denominator in the calculation. I'm going to go ahead and write that number here briefly so we can all see it on screen. And then next, I need to know what our numerator is. To calculate the default rate, I'm going to go ahead and clear. Deselect all for loan statuses. We want to look at just those loans that were completed in default. Those would be those loans that completed with settlement with profit, settlement with loss, deed in lieu, foreclosure sale, or real estate owned. And as you can see, 41 mortgages pop up under that search. I'm going to go ahead and grab my pen once again to write down that number here. This formula is how you can determine what our default rate is. After calculating out, you'll get to a number close to 2.6%. Now, for over a decade of being in the lending business and for over 2,000 loans coming and going throughout the marketplace, we feel that we have done an outstanding job in mitigating the risk for our lenders. And it's also important to note that these transaction types here of those loans which were completed in default does not necessarily mean that the lender lost money, only that something happened besides being 100% paid in full within 12 months. I'm going to go ahead and erase all those drawings so we can get back to the presentation. And now I'm going to go ahead and navigate back to the home screen. And I want to wrap up with a few common questions I get all the time from our investors, and also go over a bit of Q&A from submissions we received during the presentation. So, when should I invest? It's a question I get asked all the time, and my response is anytime. We offer fixed income opportunities with limited variables, not like the stock market, where any piece of news can affect your return. If it's up one day, down the next. With secured note lending, you don't need to time the market. Rather, that is what the borrower needs to worry about, not you as the lender. The buyer is the one who needs to bear the risk of the market values, the maintenance and vacancy of the property, etc. You as the lender are only concerned about your position. So a great position on a solid property is always a good investment. Another question I get asked all the time is, why should I invest? And again, great question. And there are many different answers because every investor has a different criteria. One of the criteria that we often use as a benefit of why you should invest is the passive income nature of debt lending notes. You as the lender, after making your investment, simply get to sit back and collect those monthly payments on the mortgage note for the interest owed. It's also, when you're investing with us, we're very thorough and consistent. We've been around in the space for over a decade, and you know what you're going to get from us. Not only are we knowledgeable, but we're also very transparent. As we showed on the mortgage marketplace, we keep all of our listings on there for the public to view. And anyone can conduct their own due diligence and see each individual loan that we originated. Another positive aspect for why you should invest with us is the safety. We always secure our notes in first lien position, meaning that you as the lender always have priority. We are very conservative in our structures and the values that we create for the property. And we want to underpromise and overdeliver as much as possible. So you as the lender are always in a good position. And finally, we really take a hands-on approach. We're very involved in managing both our active pipeline and managing you as the client, being involved with phone calls, available for questions and service, however we can help throughout the process. So thank you guys so much for bearing with me as we went through the material. I'm going to go ahead and pull up our screen real quick, just with a few frequently asked questions that we have received often from the investors such as yourselves. So I want to go ahead and just cover a couple very quickly before wrapping up the presentation today. The first one is, how does Marshall Reddick make money? I promised I would circle back to this one, and it is a great question. So just as any conventional lender, when the borrower is seeking out financing, the lender charges that borrower loan fees, such as points, any sort of document preparation or processing fees. Those are all borne by the borrower. Now, I do also want to note that on the lender side, there are two fees that are corresponding with each transaction. I'm going to go ahead and pause for my slideshow briefly and jump back to the website. I'm going to go ahead and navigate to that available listing, which we reviewed before, and point out that for each transaction, there is a $150 funding fee. Also, on the back end, as you can see on the website, there is a $200 release fee. This is collected to help us facilitate the release of the lien post-closing. We handle all the document preparation, making sure it gets recorded, and we do a lot of the legwork for the lender, and this fee helps to cover those expenses. The next question is, I have an existing mortgage. I'm interested in selling it. Can Marshall Reddick help? And the answer to that is, we would love to hear from you. If you have a loan that you're interested in selling, we'd be happy to discuss it with you. And after reviewing it, going through our due diligence and finding out if it fits our proprietary guidelines, we would be happy to entertain listing it on the website as available to our lending partners, such as yourself, or clients who are interested in investing in debt notes, to select and fund. The next question is, how is my income from this investment taxed? Now, I do want to preface that I'm no CPA, but it is ordinary interest income. In terms of the forms, such as a 1099 INT that maybe some of the folks on the call are familiar with, it is up to the borrower to issue those forms to the lender. We as Marshall Reddick are not servicing the loans. Rather, the borrower directly pays the lender for interest incurred during the term of the loan. While we are there to help make sure those payments arrive, at the end of the day, it is the borrower's responsibility to provide that form to the lender. In the event that no form is provided, it is recommended that you speak to your professional tax advisor to determine how best you should report those earnings on your next income tax return. Again, what safeguards does Marshall Reddick implement to protect the direct lender? And that's a great question as well. Again, we're very conservative, and our goal is to protect the lenders. We always side with the lenders. We do so in a variety of ways. First is during the underwriting process. As I mentioned before, I firmly believe that our default rate is so low because of our attention to detail. We review, we revise, we review again, and we make sure that the structures and the loans we're presenting on the mortgage marketplace are ones that we feel comfortable with and abide by our Marshall Reddick lending guidelines. Further, we also ensure to make the lender be protected in all parts of the transaction. We use third-party escrow services. We always get title insurance. We get dwelling and liability insurance on the property, and so on. Also, with every loan, we record your lien against the property using notes such as a security instrument, which lets everybody know your position on the property and confirms it. Also, we use a promissory note, one that specifically details the terms of that listing that the borrower signs and execute in their own handwriting. These are just some of the items that we use to help protect the direct lender. And we really pride ourselves on making sure that we only offer the best opportunities available on our mortgage marketplace for investment. Now, before going any further, I would like to bring in some questions from the chat. So doing so, I actually have our Director of Private Lending here, Patrick Prenti, and he has been chatting back and forth with you guys and answering those questions throughout the presentation. But now he wants to bring up one that would be a benefit for all of us to hear. So Patrick?
Thanks, Aaron. Really appreciate being here with you. You've done a great job. We do have some great questions coming in from the crowd, and I thought that the audience would benefit from hearing those. So the first question I have for you is, what does the interest guarantee period mean?
Absolutely, and that is a great question. The interest guarantee is placed there with the lender in mind. As a lender, you are putting forth your dollars into the note with the expectation of earning a certain return. So what we do as an incentive to you and as a protective clause to you is we put a period of time, either 3 months for our shorter 12-month loans or 2 years for our longer rental loans. And we guarantee that the borrower, while they may pay off the investment at any time, you as the lender will collect at least 3 months for those short-term loans or 2 years worth for those rental loans of interest. And so that guarantee is something for you as a lender to know that if you choose to invest in that note, while depending on how the loan completion process works, you as a lender can make sure that you recoup a certain amount of capital on that investment.
Great answer, Aaron. I'm going to go ahead and add a little bit of color to that. So we do make 2 different types of loans. I like to classify those as short-term and long-term. And again, our short-term is 12 months maximum, where our long-term is generally going to be 5, 10, 15, or even 30 years. So on our short-term loans, there is a 90-day or 3-month interest guarantee. So in the event the borrower, who's maybe a fix and flipper, gets an amazing offer to sell the property and they decide to pay off in, say, 15 days after origination, they're welcome to do so. But in doing so, they haven't held the loan for the full interest guarantee period. So you can equate that to a prepayment penalty, wherein if they did pay off in that 15-day period, they're going to be obligated to pay you a full 90 days or 3 months worth of interest. Taking that a step further into our longer term loans, if those are our rental type loans, and again, same scenario, market's rapidly appreciating and our borrower gets an amazing offer to purchase that home, right? But they've only held the loan and paid on it for, say, 18 months. Right? There's a 24 month or 2 year interest guarantee. So if they decide to go ahead and pay off at month 18, no problem. They're welcome to do that. They owe the remaining principal along with a prepayment penalty equal to the deficiency in the interest guarantee, which in this case, 24 minus 18 months, we're looking at 6 months of additional interest that they would owe you to pay off. So that adds a little clarity there to what the interest guarantee period is. And almost all of our loans, with the exception of the bridge program, offer an interest guarantee. Aaron, I got another question for you.
Fire away.
Yep, so this is a good one. How are the interest rates set by Marshall Reddick?
Absolutely. So you'll notice on the website where I showed you for the borrower loan programs, I'll go ahead and just navigate back there now so you guys can all see what I'm talking about. From the home page, you would go ahead and hover over borrow and select loan programs. You'll see that there are a variety of interest rates. They range from 5.95% down maybe even to 4.95%, up to, at our maximum, 12%. These interest rates are set corresponding to the level of associated risk with that investment. For some of these renovation loans, these are definitely the more risky loans in our portfolio. Why? Because mainly they're dealing with dilapidated assets where these borrowers are coming in, buying the properties at either, in disrepair or needing some sort of work in order to get them stabilized. And you as the lender are lending dollars to help them acquire and fix up that property, which they hope to then either sell as a fix and flip, or perhaps maybe refinance and hold long-term as a rental. But on those various interest rates, you will notice on the loan to value section corresponding to the right, that as the percentages of loan to values increase, so does the interest rate return. So in that same breath, if you're looking on the website and you see a lower interest rate, that is a good cue for you to recognize that that is likely a safer loan at a lower loan to value that offers more protection for you as the lender. If you look on the website and see one of those higher yielding notes, maybe for example that 12%, you know that that loan is going to be at very high loan to values. So again, while we do our best to conservatively structure each loan into a position that will mitigate the risk as much as possible, you as the lender are putting forth a tremendous amount of dollars towards that asset in correspondence to what the current market value is. And so you being at such a highly leveraged position will bear a bit more risk than you would if you were lending at, say, 50% loan to current market value. And so that is the reason why you will see a disparage in the interest rates. It has to do with the level of risk and safety for you as the lender.
Yeah, great answer. I'll also add a little bit of color there, folks. The bottom line is that we, don't take this the wrong way. We make up our interest rates internally. These are not tied to what the Fed's doing. These are not tied to any index like, say, Prime or LIBOR or any of the sort, right? But we have to be very calculated in how we determine these rates. In the private money space, there are many people that charge significantly higher rates than this. But the type of borrower that they're attracting is the weekend warrior. It's the first timer. It's someone that doesn't know any better. And with the flood of private capital coming onto the market, we have to be extremely competitive in our interest rate to attract the best talent. And that's one of those underlying factors that we haven't touched on tonight, is that the borrowers that we're lending to are sophisticated professionals in the real estate business. They are not the weekend warriors, right? So we feel that the rates that we publish, that we reserve the right to change at any time, right, are that very, very happy medium where it's still a fantastic yield to the lender, but also a palatable and very good for the landscape value to our borrower base. That was a great question from the crowd and a great job answering that. Yeah, I've got one more that I'd like to ask, and then I'll let you finish your frequently asked questions. And this is a loaded question, right? So what happens in the case of default?
Yeah, absolutely. So, in every situation, I'm going to go ahead and put these slides back on the screen and get back to where we were before. But in every loan that we originate, we always assume that it's going to pay off correctly. That's what we're always going for. But every once in a while, despite our best efforts, despite how we structure the loan, something happens and the deal goes sideways. In the event of default, our goal before originating every loan is to think and say, based on our loan structure, do we feel that the lender is protected if in the event the deal goes sideways? In the event of a default, we as the private lending team would come alongside you and help you walk through that situation. That can happen for a number of reasons. Perhaps the borrower is just short on cash, or perhaps they just need more time. And unfortunately, you as the lender are deciding that more time is not something that you're willing to give at this point. But in the event of default, as mentioned previously, you are acting as the bank. You own 100% of the note, and therefore you also own 100% of the responsibility and liability of the outcome of that investment. Now, we definitely can help you. As Patrick mentioned, we work with a lot of sophisticated borrowers, and we also work specifically in markets where we have a lending footprint, meaning that in the event of a default, we can help connect you with those people who will help you resolve the situation, whether it be if you want to go through a foreclosure process We know of attorneys and contacts out there who can help you do that. If after you have taken over the property, you want to stabilize it yourself and sell it, or if you want to simply stabilize and hold it as a rental, we have folks in that market who help you do that as well. So in every situation, while we always do our best to ensure that every loan is structured in a way that will not end in default, if one does, and it does happen in private lending, that is an element of risk that our lenders need to be aware exists, we do our best to make sure that we are with you and providing you the education and providing you the knowledge and resources so that you can best make good decisions and navigate through that situation.
Yeah, great answer. Well, you guys have to understand when deciding whether you're going to become a direct lender versus potentially become a Marshall Reddick mortgage fund capital partner is that obviously when lending money, defaults are part of the business, right? And that's, you have to look at it. This is a business, and a default's the worst case scenario, right? It doesn't happen often with us, but it does happen. And so the way you have to look at every single loan that you're deciding and doing your due diligence and like, am I going to buy that loan or am I going to fund and originate that loan? It's like, am I okay owning that asset for the loan amount? Right? Because that's your worst case scenario, right? We only lend in first lien position. So that means if there is a default, you're in the driver's seat. Marshall Reddick, as Aaron stated, is here to help you, and there's no charge for that consultation, those ongoing consultations, those conversations with the attorney that you might need to hire to send the demand letters and to actually execute on the foreclosure process if you have to go that far. But just because there's a default, again, doesn't mean that there's going to be a loss of interest nor a loss of principal. And it doesn't mean that you're actually going to have to foreclose on the asset. There are a lot of default mitigation tactics that we can use as a go-between between the borrower and the lender. Because most of the time we've got that pre-existing relationship with the borrower, and it doesn't do any good for them to force you as the lender into the formality and the expense of the foreclosure process. However, if the borrower disappears, their communication is bad, and we and you together feel that at any point in time that your lien position is at risk, it's a straight business decision, and we will not hesitate to lawyer up, again, always with your approval as the loan owner, and we will take it from start to finish until that property is either sold at trustee sale, which is the culmination of the foreclosure process. And in the event it doesn't sell at trustee sale, then you would become the titled owner of the property legally by enforcing your rights as the first lien holder. And in that case, once you take legal title to it, it's up to you what you would like to do with that property, right? And we showed the marketplace and we showed all those loan statuses. And so an example of that would be deed in lieu of foreclosure, or would be an REO. And that's a situation where the lender, in lieu of the loan paying off, actually took ownership of the property. So as a direct lender, you cannot lose 100% of your capital. That doesn't exist. You always have the collateral asset behind you. And then again, in the worst case scenario, you have to own that asset, whether you fix it and sell it, whether you sell it as is, where you fix it and keep it as a rental, or maybe it's already in good enough shape for you to keep it as a rental and then you choose to sell it at some point in time down the road. In either case, taking this, again, a first lien position approach, you always have the collateral property to fall back on, which is why I'll conclude with the fact that when you look through the lens of every loan you're considering funding, must be looked through the lens of, am I okay owning that asset if I have to for the stated amount of the loan? And if the answer to that is yes, well, then you feel great about making the loan, knowing that Marshall Reddick's historic default rate is under 3%, right? Because chances are you're never even going to get to that position. But if you do, hey, you're okay owning that asset in the first place.
Absolutely. And thank you, Patrick. Those are great questions and feedback. So thank you all for contributing. So I only have one more frequently asked question before ending the webinar. And this question is, what is the Marshall Reddick Mortgage Fund? As I mentioned before, there are two options that we make available for our lenders. There is a direct lending option, which we covered tonight. And there's also the pooled investment option, which is the Marshall Reddick Mortgage Fund. You can find out much more details about that on our website. And we've also done past webinars on that topic as well. So while I won't touch too deeply here, essentially what it is it is a Regulation D 506C private placement where a number of capital partners come together and collectively pool their capital, which we, the Marshall Reddick Analyst team, and Patrick Prunty, Director of Private Lending, then direct the investment of that capital to create a return for the investor. Benefits of the pooled investment model include diversification. Rather than you just having maybe 1 or 2 notes at any one time, the fund will allow you to have hundreds or maybe even thousands. So that diversification is there. Another is the passivity. Rather than selecting each note individually, the fund takes care of selecting and keeping your dollars invested, which is a huge benefit for certain investors. So I do want to note one final touch is that for the fund, there is a requirement that only accredited investors can join. But if that is an option that appeals to you as an investor, please visit our website, give us a call. We'd love to speak to you about it, and we'd love to discuss if it is the right investment for you.
And to conclude, Aaron, if you would just show them on the website for those
Certainly.
folks who are interested in learning more about the mortgage fund, there is a specific site set up.
Absolutely. So if I go here to the Marshall Reddick homepage, which you should see on your screen, and hover over the investment tab, right here, you'll see the investment fund section. I already have this open. And as you can see, this page shows the different details about the Marshall Reddick Mortgage Fund that you can explore in depth when you're conducting your due diligence.
So this is just a good resource for you folks if you're interested in doing more due diligence, right? This is the best place for you to get started.
And if you like to get started on that process, as Patrick mentioned, there is a little button here for Invest Now, which you can click, and after logging in or creating an account, can get someone who is an expert on the fund to reach out to you and help answer those questions, whether it be myself, Patrick, or one of the other fund advisors that are here at Marshall Reddick Real Estate. So that concludes our presentation. Thank you again, everyone, so much for your time. Really value being here with you all today. Again, my name is Aaron Byrne. I'm an investment analyst here. My contact information is on the screen, so please, if you have any questions or are curious about learning more or would like to get involved, do not hesitate to contact me. My phone number and email address are both on screen. And once again, thank you all for your time. I'm going to go ahead and end the presentation here shortly. So everyone, have a great rest of your day and look forward to seeing you all next time.